basically software companies are kind of scrambling of how do they keep their positioning because now almost anybody can replicate their business overnight. And as a result, those same investors who love that sticky revenue are now going, well, what are businesses that are insulated or protected from AI? It's going to be real world in real life businesses, like you mentioned.
This is the ultimate plot twist that no one saw coming, and it's sort of like poetic because for the last 15 years, this space has been not gotten the credit it deserves. It's been spoken about like it's a fallback plan. It's been spoken about like it's low skill. And it's just like that's always really pissed me off. And so I find this whole switch kind of hilarious, to be honest. So I'm just watching this be like, oh, gotcha. Like, who's the smart now? Turns out these businesses are super, super valuable, super essential, super needed. We knew it the whole time. It's just like now apparently that's obvious to you guys too. You're watching the LeanScaper podcast, where landscapers come to grow. If you want the systems, stories, and strategies to build a lean, mission-driven company that your team loves working for, keep watching. Morgan, how are you? It's good to see you. Welcome to the show.
It's good to see you too.
This conversation is sort of an emergent one, and the conversation is one about private equity and landscaping. What are they doing here? Why are they interested? How does all of this work? And I think, given your experience putting together as many deals as you have, looking at these deal cycles, working with buyers and sellers, and being in the whole M&A environment, I feel like you're the perfect person to ask this first question too, which is, in your mind, like, why do you think landscaping is on private equity's radar?
Yeah, well, I think it's changed over time. So the initial thought or thesis, most private equity firms are looking at industries where there's not a lot of consolidation that's occurred. So it- especially in Western Canada, is a classic example. If you're out in BC, beautiful weather, there's year-round need for landscaping. And so the reason, basically what happens is that anybody with a truck and some basic tools now can slap a sticker on their truck and say, hey, I'm a landscaper. So you have this crazy amount of fragmentation of service providers. So the thesis around private equity is if we were to buy a bunch of smaller companies, package them all together, we're going to be more efficient because we're going to reduce redundant costs. We have a centralized team, and we're going to be more profitable than your average mom and pop smaller business. And so for a long time, that was the driving thesis of private equity in HVAC has been one that's been going on for a really long time, roofing and others. Landscaping's also starting to see that. The other thing with landscaping, it has that recurring revenue, contracted revenue, sometimes government contracts or big strata on those maintenance side, which allows for more predictable cash flow, which is like what an investor's dream. The last thing that's been changing on on the private equity side in general, but also specifically pushing a wave into the blue kind of collar trades, and then other services like landscaping is AI. Like AI is now pushing investors who used to consolidate tech companies to go, maybe our strategy is completely flawed now with AI. We don't have as much of a moat as we used to have. So let's buy real world businesses that are more insulated from AI. So you're starting to see that too. So I think it's actually a pretty kind of golden era almost for owners in the space.
I'd really love for you to say a little bit more about that last point. We don't have as much of a strategic moat. That's a very sort of like techie term. Like, why is it? And I know the answer to this question. I want you to sort of lay it out here for the audience. Like, why is it that these more, I call them like IRL, in real life businesses versus like in the computer businesses. So like the blue collar economy more broadly, but landscaping more specifically. These are companies that operate with human beings in the real world, in vehicles, out there on sites, in the dirt. Why is it that those businesses in the age of AI are all of a sudden more appealing to quote unquote smart money than they were 5 years ago?
Yeah, so the big thing that's happening on the tech side right now, for those that aren't familiar, the golden business to buy, the business that got the best valuations or the highest price, were software as a service companies. So think of like any tool. QuickBooks Online is a SaaS company, which many of the people listening would use in their business, and they probably use a bunch of other tools in their business as well. Those businesses were great because they have really high margins. We're talking 80, 90% gross margins. And sometimes their profit margin was well over 50%. So basically, they were just cash flow kings, and you could scale them without having to hire more staff, usually. Investors really like that because they could put $1 into the machine, have the business grow super fast, and it would just basically return money back out. And they were willing to pay these big price points for it because it was once you kind of start using a software provider like QuickBooks Online, it's super hard to switch to another provider because
It's
it has all your
sticky is the
information.
term they use. It's
Very
sticky
sticky,
sticky revenue, right? Once you're
very
on,
sticky.
you're stuck. You're not gonna get off
Yeah.
it, and investors like that. Sorry, continue.
Yeah, investors love it. But what's happened recently is now with AI, there's these AI coding tools where now a programmer who used to work at a big company can now have a team of programmers just as an individual and rebuild some of these software companies that have thousands of employees. They can build a cheaper alternative, um, to basically replace that software at a lower price point. So now there's like basically software companies are kind of scrambling of how do they keep their positioning, because now almost anybody can replicate their business overnight. And as a result, those same investors who love that sticky revenue are now going, well, what are businesses that are insulated or protected from AI? And that's going to be businesses where until we have robots that can take over the role of entire landscaping operations, it's gonna be real world in real life businesses like you mentioned.
I've said this before, but this is the ultimate plot twist that no one saw coming, and it's sort of like poetic because for the last 15 years, I think that this space has been, wow, not gotten the credit it deserves. It's been spoken about like it's a fallback plan. It's been spoken about like it's low skill. It's been spoken about like it's a secondary or tertiary option, something that you do if you can't do anything else, which has always really, really bothered me. I'm from a blue collar family in a blue collar town. I've worked in this space and worked with these entrepreneurs for most of my career, and it's just like that's always really pissed me off. And so I find this whole switch kind of like I'm like hilarious to be honest. So I'm just watching this be like, oh, gotcha. Like who's the smart now? Turns out these businesses are super, super valuable, super essential, super needed. We knew it the whole time. It's just like now apparently that's obvious to you guys too.
Yeah, well, and what the one thing that I'm kind of doing with Breakwater, and it's kind of in this the mantra that I've developed is there's now it always rubbed me the wrong way too. I'm obviously very involved in the tech kind of community and the investor community. And it was kind of always had there was always this like looking down at the blue collar. Oh, okay, that's a nice, business. Meanwhile, most blue collar, trades guys are making way more than your average tech worker, or somebody who's in the white collar workforce, and oftentimes are own their own business and have all these other benefits. And so I think now the nice thing is that I'm helping these owners exit at a really high, exit price from the same people that used to, you know, kinda look down at their businesses, now wanna buy them, and I say, "Why not sell it to them at a premium?" Because they deserve it, they've built a really great business, so, yeah, it is really funny how it's switched around, re in
Yeah.
recent years.
So I pulled a list just from kind of like previous podcast episodes I've done a little bit of research and I just thought I'd rattle off a few things here before we move on to the next section. When we go back to the question I asked originally, what is interesting, what is appealing about this asset class to private equity, which on the surface on the surface it maybe kind of shouldn't be. Yeah, private equity. I've heard this quote from a guy the other day, which I love. He's like, investors are like investment money is fundamentally lazy. Entrepreneurial money is fundamentally active in the sense that they want to buy something and build it. Investment money, private equity money is usually a bit lazier. They want to buy something, park it. They want to assemble a few things. It's not like they do nothing, but they're looking for easy moves and high returns. And so on the surface, you go, there's nothing easy about running a landscaping business. Well, this is a bit of a head scratcher. Why would you be interested in these? But if you peel the onion back, so to speak, there's a few things. You mentioned already fragmented industry, thousands and thousands of small firms make up the space versus a few big ones. The recurring revenue is a big piece. So unlike other trades businesses, there is a maintenance and a service component to a lot of these companies. Snow and ice management is something they like. It's an essential service, which means that it is largely recession proof. Like the grass still needs to be cut, so things can really, erode here economically, and these businesses still function. There's a bunch of cross selling potential that I think is interesting, where you can sort of bolt on services or become more of a full service business. Private equity likes that because they want to basically, the term they use is surface area. They want to expand the revenue surface area that they have on their customers by selling them more stuff. They are the boomer retirement thing is a big piece too. You have there's a perfect this is timed well in the sense that you have 10,000 boomers retiring a day. A lot of them own businesses. There aren't that many buyers to take them, so that creates an opportunity for them. And then lastly would be just this massive professionalization opportunity where um you have and this is a bit of a stereotype, but you have a lot of businesses that are under professionalized. They are still pen and paper. They're slow to return phone calls. The website is clunky. Their uniforms are dated. Like it's I would say if you're listening to this podcast, you're not in that camp because you're sort of on the more future facing tech forward cohort, but a lot of your competition is, right? And so you need to think about the broader environment. If it is, let's just to use a term, rough around the edges, private equity in theory, I don't think they actually are able to do this, but in theory will bring more of a polish and more professionalization. They'll add systems and they'll make these businesses a little bit more a little bit more presentable to the public, to the customers. And so I just thought I'd round out the answer to that question. Those are some really compelling reasons to an investor to move into a space like this, even though they are hard businesses to run. So let me just move this along here, Morgan. Like the tale of two landscapers would be how I set up this section. Walk me through, at a high level, at the very least, what is a good exit and what is a bad exit when it comes to contractors or service businesses selling?
Yeah, I'm going to share something that most people get wrong, and which is as a small business owner, you're a lot of people get lost into what's the right multiple of EBITDA and what price point should I get. But the reality that most people don't realize until it's too late and then they're really stuck is that a bad exit as a small business owner is no exit at all. Like your business isn't saleable and now you don't have the time to actually get your business ready to sell. And then you have to wind down the operation or hand it off to an employee at basically for free effectively. And
What
so
percentage, sorry to
yeah.
interrupt, Morgan, what percentage of businesses sadly kind of end up in that spot? Is it the vast majority?
Yeah, it's there's some really unfortunately it's not great data, but it's up to 80% of businesses fail to sell is the common phrase that gets thrown out
In
there.
other words, they're gifted, or they sell the spare parts and get what they can get for the equipment, and that's the end of that.
Yeah, and it happens all the time. I've seen really great businesses that talk to us and go, "Hey, I don't know if I'm gonna be able to get anything for this, and I'm just gonna think about winding it down." And they have a saleable asset, and it's kind of insane. But yeah, exactly that. Often the path goes, I talk to my general manager or lead operations person. They don't have the cash or they don't really want to be a business owner, like being an employee. I talk to my kids; they have no interest in doing what I do, and I don't know where to go. So I might as well just wind this down. I talked to one competitor; they weren't that interested because now they know that if I don't sell, they can just pick up my client contracts for cheap. So then they don't know what to do when they can oftentimes sell. So there is a path. The good exit, so the bad exit is basically what I just outlined. The good exit is, I think, and you were kind of talking about these as well. Anywhere between 3 times EBITDA, and we'll talk about define what that means, but basically your cash flow that you receive as an owner, in the business, so not necessarily the one you report for tax reasons, but the actual cash flow of the business, up to 3 times that, upwards. Some of these larger landscaping companies are getting 6x, sometimes even more. So if you wanna think about it from just a pragmatic kind of viewpoint, it's you're getting 3 years worth of profit in advance, or sometimes even more, 5, 6 years in advance on and when you're ready to retire. So in addition to all the money you've pulled out of the business over time, which can be pretty attractive, obviously, if you're at scale, then it starts to every dollar of profit you start to generate, you can see $6 of return on that money.
Pardon the interruption, but if you are a mission driven leader in the landscape industry who is hungry, humble, and smart, and you love this show, you should subscribe to this channel. That way you'll never miss an episode. Yeah. So if you look at back to this like tale of two landscapers thing, if you were to look at a business owner who just sold for 6x, um, and and it was a clean exit. In other words, not some crazy long earnout, not some sloppily put together deal that has them still attached to the business for 6 years when they don't want to be. I mean, that's like an extreme scenario, but generally speaking, you want your money, you want to get out pretty much as fast as you can on these
Yes.
things. Um, when you look at that scenario versus someone who doesn't sell at all, what can you say? How would you describe the difference in mindset, habits, systems, like the way that they carry themselves? Like, is there a pattern between these two ends of the spectrum, these two poles?
Yeah, so I use this analogy all the time, and it really just breaks down the difference that the valuation of your business and the saleability of your business are completely two different things. And so the biggest difference is that there's a strong saleability case. And I'm going to give you an exact breakdown because I just in the last recently sold two landscaping companies, one of which should have been worth more than the other, but it failed to sell because of what I'm about to describe
Perfect.
here as well. So the saleability versus value, the analogy I use all the time is let's just take a YouTube, like a famous YouTube influencer channel or something that makes millions of dollars a year from sponsorships and things like that. On paper, it's a very valuable business. It makes profit. It's, paying for a team. It can scale. The problem is that you can't sell that business because it's so tied to the owner of that YouTube channel. There's a lot of dependency on that YouTuber. If you or I were to jump in, and even though you're a great interviewer and a great face for podcasts here, Benji, I don't think that they would be like, "Who's this guy?" And then it wouldn't work. So it's the same thing with your landscaping company. If you're doing everything, you're doing all the estimation, you're doing all the key components of your business, somebody is going to be very hard to find a buyer who is an exact carbon copy of you. So then it becomes harder and harder to sell. This was true in a different way with the two different businesses I'm going to outline, where we had one business that mostly focused on maintenance contracts with government. The owner was a full-time firefighter, so was actually not involved in the day-to-day operation. So there's another green light. So we have maintenance revenue, which is highly valued, government contracts, which is also a nice benefit, and wasn't involved in the day-to-day. Ran the business remotely, had teams throughout the province doing different business. Everything was great. The catch was that of those government contracts, they made up 70% plus of the revenue, and they were on 2-year annual contracts. And when he wanted to sell, he had to. He didn't have a choice to wait it out. The contracts were set to renew in the next year, and he didn't have any confidence that they would get renewed. He had no determination. So now a buyer's going to have to come in, take a risk that 70% of the revenue could completely disappear in the next 12 months. It made his business worth, really, I think we got just over 2x with a bunch of deal structures. So basically, it was contingent on the contract being
Right.
renewed to receive his payouts. On the other hand, we had another landscaper who I believe got like 3.5 times. It was a small, these were both sub kind of million or around a million revenue businesses. The other one did a lot more installation work, which generally is valued lower, did some snow removal, but had a wider diversity of revenue from different customers. Owner wasn't super involved in the day and was willing to stay on a little bit longer and got a much higher multiple. The first business was one that was definitely more interesting, should have gotten a much higher multiple. The first business got, I think, 113 NDAs submitted on it, so a buyer interest. The second one had like 12 or 13, but still got a higher price. So it
Yeah.
really, like, it's not just all the numbers ultimately at the end of the day.
What I'm really struck by is this this pattern, I don't know how to how I would describe it. It looks to me when I've spoken, and I've not sold a business. We've worked with a bunch of companies that have. We are currently working with a bunch of businesses that are in the process, and I know, and in my direct network of mentors and friends, I have at least 20 recently or not so recently exited entrepreneurs. So if I've just had been around this conversation a lot lately, what I've noticed is it looks to me, and maybe you can comment on this, you're kind of like trying to you think of like a conductor and an orchestra, like trying to bring this thing to a crescendo, and you're trying to manage all these metrics and get this thing to basically look as perfect as possible at the perfect time for a buyer and then get out as fast as you can. I don't know what the term is. You're like trying to bring this all. Okay, maybe here's a good analogy. You're trying to sell a house. You stage the house, you do a paint job, you get the lawn done, you make it look as good as possible. You list it in the spring so that buyers are active. It's this now, that's a good analogy, but the thing is selling a house is so much simpler because it's basically just a fixed asset. There's a few things that maybe tilt the dot there's a few knobs that tilt it up and down. In a business, there's like a million knobs to turn, and the job of a owner who's trying to exit, to me, it looks like they're just trying to like get them all optimized as quickly as possible, or not as quickly as possible, but in unison, so that this thing basically on paper and in reality presents in the most profitable way, and then they want to sell at the perfect time and get out. And is that a fair way to describe it? Is that maybe an apt description of what owners who are trying to exit are essentially doing for the last 3 to 5 years of their journey?
Yeah, like we often refer to it as exit planning. So, working through a checklist of items. So, we started to develop a program called Exit Navigator, which effectively is giving owners we go through a couple interviews with them, and then we provide them their current market valuation based on where their business is today with no changes. And then we show them the path to what their valuation could be based on kind of some low-hanging fruits, and we give them the exact value that we estimate could enhance their business valuation. The problem is that most owners are reluctant to do this process for whatever reason until they're ready to sell. And they're like at the point of like, it's a Friday and they're like, can you sell this thing by Monday? I'm totally burnt out. I'm totally done with this thing. And it's hard to make changes in your business when you're running on fumes. It's a lot easier to do it when you have the energy. Even if you aren't planning to exit, what I always say is if you could get your business to be more consistently profitable and also easier to run, would you do it? Well, yeah, of course. Well, that's all exit planning is. And so what we work on is, and I think we're going to talk about them in a minute, is basically the specific buckets that improve a business valuation, especially in the landscaping space. And what we do is we break those goals down into quarterly goals and then also 12-month, 36-month, depending on that timeline. So even if you're 5 years out from selling, it always makes sense to start doing some of these things. A lot of it's just cleaning up your documentation, starting to extract yourself from the day to day of the business, and really just trying to increase sales is really like the really dumb it down. Those are going to be the biggest things that are going to move the needle for any
We'll
business
we'll
owner.
get into these buckets, but what is, a realistic timeline that you talk about with owners? So if you want them to avoid the situation where they come in burnt out, exhausted, just saying, "Sell this thing," which is not what you want, and they are more proactive. They're like, "Hey, I'm a bit tired, I'm not exhausted yet, but I do wanna get out of this thing, and I do wanna maximize my value." How long is, like, a good time frame? What's a rule of thumb there to get it ready?
Yeah, 12 to 18 months is going to be like I find is a pretty effective timeline to do some pretty significant changes. So if you really want to improve the valuation component, you usually need a new year's worth of financials or at least your last 12 months have to be pretty strong. If you've had a couple rough years or if your revenue and profits been up and down, it's going to be harder to do. But if you kind of had like a bit of a consistent growth, if you're able to get a really strong 12-month period of time, that's going to help with boosting the valuation. The sales process in itself, even I think the fastest deal I've ever done was like 2 months from launch to close, like money hitting the bank account. And that was like crazy fast. Oftentimes it's anywhere it's 6 to 8 months. Sometimes it could be a year. And then if you have complications like this, basically this other business I had that had like this contract renewal, sometimes it could be, that acquisition might actually happen for over 12 months. So just that in itself, it takes quite a bit of time. So I would usually say if you're starting to think about it, planning a year out or even 2 years out is going to be kind of the best path. And it doesn't hurt, right?
That's shorter than I thought. I thought you might say they need like 5 or 6 years to do this well, but that's you can do this in a couple calendar years.
Yeah, it depends. Like if someone's goal is a $20 million exit and their business is worth one, it's gonna be obviously, it's
Okay.
gonna take a bit longer
It's
than
a pretty
12
big
months to get
delta.
them there.
Yeah. Yeah.
Yeah, yeah. So,
Yeah.
depends on the owner's goals, but the part of the problem is that I have people that come to us and say, "Yeah, my goal exit, I want $10 million," and then I have to tell them that their business is worth nowhere near close to that, and now what do we do? So, getting ahead of it is something that we do with just giving people a free valuation because we go, "You need to know where you're at currently to make the best decisions for the future."
One of the things quick tangent here. One of the things that I've noticed, about people trying to sell their things is that there's definitely some human psychology going on here. There's a very obvious, to me at least, pattern of people falsely believing that their stuff is worth more than it is. Spend 5 minutes on Facebook Marketplace, right? And you're gonna see people trying to sell a 10-year-old used mattress for $1,000. It's like, how many clicks are you getting here, dude? Like, and write him an
There's
offer.
probably a
It's like, "No, no,
market for that, to be
I
honest. There's probably
I don't know, man. Maybe there is, maybe there isn't. You might know about the more about the used mattress market than I do. I'm commenting on this proclivity that human beings have to really have stories and belief systems in their mind around what their thing, in this case, their business, is worth, and that being wildly different from what the market will bear. And the term I love is just like it's worth what someone will pay for.
Mhm.
And have you what has been your what have you observed about the difference between those two things? Owner thinks it's worth this and it's not. The market says it's worth this. How would you explain often those pretty wild swings in internal mental valuation versus market-based valuation?
Yeah, well, I think that the problem is gonna be the historical bias owners have of all the sweat, effort. Like, if anyone's run a small business before, it's effectively, I think there's a saying from a kind of a famous operator in the small business world talking about how it's like a daily knife fight. Like, you're just constantly battling, and it's an absolute grind, usually to get it started too. I think that's like there's just this whole history that owners think that go, all this work and now I'm just gonna get this? Like, I think it's worth this based on the effort I've put in. Unfortunately, that's just not how things work. Like, if you post a video or a picture on Instagram at the top of a hike and you're looking happy and it's a beautiful view, people just see that. They don't see the fact that you had, like, poison ivy and you walked through and you twisted your ankle and you fell down the cliff 3 times. They wouldn't see that. They just see the end result, which is, "Oh, great, you got to the top of the hill." I think that's the same with businesses as well. Like, buyers are not one, they're not gonna reward you for the effort you put in to get the business to where it is. They're gonna pay what they're gonna pay. The other thing is you have to have this intellectual honesty with yourself as a business owner and go, "Hey, if I was gonna buy a competitor right now, am I gonna give them the same value that I'm wanting?" And often the answer is no. And actually, usually competitors are sometimes the worst acquisition because they go, "Well, I wouldn't pay for that much for that landscaping company." And so you have to be honest with yourself and say, if you are thinking about that with others, they're going to view your business like that too. So that's often where I find is just like it's their baby, like been
Yeah.
developing, it, especially if you've been working 20, 30 years. And it's hard when someone tells you your baby's ugly. Like that's kind of what it feels like sometimes.
I That's a really, really interesting insight, and I would encourage listeners who are even flirting with this idea at some point in their entrepreneurial journey to intellectually honest is the right term. Um, decouple their memories and trauma and
Yes.
challenges and blood, sweat, and tears, decouple all that from the actual valuation because unfortunately, and I mean that, unfortunately, that's it just has nothing to do with it. That is your journey and your story, and it's something you should be proud of. But when it comes to the market, that's just not how things transact. So it's a really interesting insight to share. Let's dive into these 8 drivers of value in landscaping M&A. This is not, by the way, like, I'm sure, the exhaustive list. There would be other maybe smaller things, but I feel like we cover, not 95% of the knobs that you can turn as an entrepreneur to increase value. So why don't you take us through them, Morgan?
Yeah, so the first, these are not in order as well, but I would say in terms of the biggest driver for valuation, I've used the word EBITDA a couple times. I'll quickly define it because
Yeah, let's do that.
some might not know. EBITDA is your earnings before interest on long-term debt, taxes, depreciation, and amortization. The reason why that's used is that your net income, if you're, or net profit, is going to be widely different across the industry because let's just say, Benji, you don't love paying a tax man. You like to take a big salary out of the business instead of dividends, so you pay yourself 500,000 a year in salary. That's going to be a big expense that's going to drive down your profit on paper. So what we do as professionals is we help you come up with your EBITDA number, which normalizes or basically makes a standardized profit number to compare one landscaping company to another. So we can go, landscaping company A has 1 million in revenue and it's doing 250,000 of profit. Landscaping company B has 1 million of revenue. It does only 100,000 of profit. Okay, something's going on with company B that's not performing as well as the other. That's what EBITDA is.
Is it fair to say that it's sort of it's useful because people tip the scales in the pursuit of tax efficiency with investments at funny times right before the taxes roll around, with dividends versus salary. There's a whole bunch of little things that buttons you can push to basically pay less taxes. EBITDA comes through and kind of wipes all that away and just says this is ultimately how efficient the business is.
Exactly,
Yeah.
exactly. It's just a level playing ground to compare a business, and then how businesses are typically valued is on a multiple of that EBITDA number. So if you have $1 million in EBITDA and you sell your business for 5 million, you have a 5 times multiple. So
And
it
so
just
what
kind
we're
of says it
talking
all.
about with these 8, and I'll let you get started, these are the factors that drive that multiple up and down.
Yes, yeah, because the biggest thing is going to drive
Along
value.
the way, funny enough, along the way, they also happen to, you'll see this when we get through them, they also happen to help your actual profit because much of them will make your business more efficient, more balanced, more stable, all this stuff as well. But I just a clean way to think about the algebra equation is you have an EBITDA, the EBITDA gets a multiple, that becomes your valuation. The 8 things we're going to cover are the drivers to push that from a 3 multiple to a 4 multiple to a 6 multiple and so on.
Exactly. Yeah. So these factors are going to support that. It's going to make your business more easily transferable. The other thing is these factors are going to do is going to widen your buyer pool. The more buyers that are interested in your business, the more competition there is. And like any good auction, if you have multiple bidders, your price gets driven up. It's just simple supply and demand. So we're trying to basically widen the buyer pool as much as possible to have multiple bidders on your business so you can pick the best fit and then also get the highest price. So
Gotcha.
that's what these things are going to do. But just to start, if you want to drive the valuation of your business, the best thing you can do is to increase the revenue and increase your EBITDA. That is going to be the ultimate biggest driver. But if you are on a shorter time period or if you feel you've capped out or whatever the case may be, focusing on these 8 things is going to make it much easier to sell your business and again, get a higher multiple. So let's kind of dive right into those. So again, not in a particular order, but the first one is going to be systemizing your business. And basically, what that means is building SOPs and documenting the key kind of playbooks for your business so that you can, if you take off on a vacation and your kind of one of your lead operations person comes in, they know how the quoting process should work. They can go onto a job site and be confident like that there's a standard that you have established for them to walk the client through the invoicing process, how it gets processed, making sure that the bookkeeping team is kind of coordinated and all this. Having systems for each part of your business makes it easy for a buyer to come in and go, this is great. There's systems in place. I don't have to invent everything when I come in. Like it's a well-running machine. It's a big one.
It's more than just SOPs though. Like I would think of that more as documentation, which we'll get to. It's like, what is your tech stack like? Do you have like workflows? Do you have a project management system? When you think about the things that a landscaping the systems a landscaping business needs, I'm kind of ballparking here. It's probably somewhere between like 80 and 120 systems that you need for systems in HR, systems in finance, spreadsheets and trackers that give you visibility into things. It's the overarching infrastructure behind the scenes that your customers never really see. They just experience the service, but these are the things that underpin your ability to do that service at scale. And
Job
so
costing is a big one. Like if you don't have a good finance function and let's just say material costs are starting to rise and you're behind, you're just doing like Excel based, tracking in your business. This happens all the time. Labor costs are going up, material costs are going up, but your job quotes are staying flat. What happens to your profit? It starts going down. And I see that all the time. And because it's like retroactive. So like a year from now, it's like, oh man, like that year wasn't as good because you didn't keep up. And systems help with that.
so systemization one, what's number two?
Number 2 is the predictability of cash flow. So in landscaping, we're also going to talk about snow removal as well, because if you are a Canadian landscaping owner, that's oftentimes what a lot of your revenue is going to be associated with. Uh, the quality of revenue. So revenue is going to get weighed differently based on how it's set up. So if you are only doing installation, like landscaping installation projects that have one-time revenue, it's going to be valued worse than if you have maintenance contracts on multi-year terms. So like the gold standard, if you could sign a big strata or a property management company and you have like a 5-year contract for maintenance where you know exactly the schedule that you need to provide and what services is, or you're just cutting a lawn and whatever that service is for the next 5 years, and you have a baked in kind of, and you have the pricing all outlined with escalation so it kind of keeps up with inflation. Great, now you can go, I know exactly how many people I need to hire for this, what my costs are going to be, and what my profit's going to be for the next 5 years for that service. So those type of contracts are valued a lot higher by investors, buyers than the one-time projects, which is hard to know on a year-to-year basis what your profit or revenue might look like.
So this is an interesting piece here, and this is an obvious point, but it does bear repeating. Companies that are heavily, heavily, heavily project based. I'm thinking of the example of like a custom home builder. If you had a custom home builder that does $10 million a year, you had a landscape maintenance company that does $10 million a year. That's a big maintenance company. The maintenance company en masse in general is going to be worth a lot more because those contracts and the reliability of those repeat customers, the smoothness of the revenue curve is very appealing to investors. Whereas, and it's not to say the custom home building company is worth nothing, but they have a much more uphill battle where multiple is concerned because they have to go out and win every single project. They come in large chunks and they often fluctuate quite a bit because of the market. And so, just to make a really simple comparison, the smoothness of that maintenance contract, you might think it's kind, mow and blow is kind of boring, and in some ways it is. It's like, if, from an investment standpoint, boring is good.
100%. And it
Yeah.
dovetails nicely into the next point, which is around diversification of services and clients. So to use your same 10 million in maintenance revenue, let's just say we had two companies that both have 10 million in kind of maintenance revenue. Great. But one of them, one of them has one client, well, the government or something that pays them 10 million in aggregate across all of its different properties, and the other one has 1,000 clients that make up the 10 million in revenue. The one with 1,000 clients is going to be worth a lot more than the one with the one single client, which is what the problem we had with that case study I told earlier. We had basically one client comprising 70, I think it was like over 70% of revenue. It makes it a lot more risky. So most of the time when you're trying to defend your valuation, you have to kind of put on your buyer's hat and go, how can I de-risk this for the buyer? That's mostly what drives the multiple, is that a buyer is going to go, I'll pay a 5 times multiple, 6 times multiple, if there's not a lot of risk, the business performance is going to change over time because now I'm going to get a rate of return that I can expect over the next 6 years. If it's very risky, which is like high customer concentration, I don't know if the business is going to be around in a year or two. That's high risk. So they're going to pay a much lower multiple.
I a quick tangent here. You've said this a couple times. I actually want you to unpack the term for us. Defend the valuation. What are you defending against?
Yeah, so you're defending the multiple in which you're gonna receive.
The
So
downward pressure from the buyer.
yes, yeah,
Yeah.
and basically there's a couple levers that buyers will use to structure a deal to your disadvantage as a seller. One of them is going to be the price. So that's kind of obvious. They just pay you a lower amount of money for your business. The other thing that most sophisticated buyers do, they'll say, okay, you can have your price, but I want the deal on my terms. And they can play around with the terms. And the more sophisticated the buyer, the more complicated it can get, which it can put you at a disadvantage if you've never done a deal before, where they say, okay, I'll give you $5 million for your business, but you're only going to get 500,000 or a million at closing. The remaining 4 million is going to get paid out over the next 5 years if you hit these targets.
And it's
If the business
conditional.
grows,
Yeah.
very conditional, and we're going to claw back, or we won't pay that out if you don't hit that. And they can oftentimes make the case for that if there's more risk in your business. So if you can have a very defensible business, go, no, I'm not doing that. This is contracted revenue for the next 2, 3, 4 years. There's no reason why this shouldn't perform. And why should I, as the owner, allow you to have the execution risk of running the business and then pay me based on that? So
It's good.
that's where you want to defend
It's
against.
a really good framing. Thank you for explaining that. Okay, what's the fourth bucket here? What's the other thing that really impacts multiple?
We touched on it briefly already. It's kind of with, in addition to systemizing, so having like really dialed in tech stack and all the kind of different tools you use in your business, is documenting how to use them, having an organized org chart. So I think one of the common things with small businesses is that you kind of have people doing a bunch of different things and they don't have a defined role or function. So there's no real team lead. You want to start to professionalize, to use your earlier term, your business so that you can have maybe a lead when a new buyer comes in. It's like, this is the go-to person in the business. That's like the operations manager. In a perfect world, you'll start to also develop like a general manager who's going to take on most of the day to day. That's going to be kind of like the gold standard. Not every business is going to get there, but if you could set it up so you're just doing financial reviews, weekly check ins, and you're mostly not involved in your business, is actually better.
SOPs, job descriptions, org charts, competency models, clean books, all of this stuff. This is going to be one of the first things on the long checklist that an interested buyer is going to ask for. They're going to ask you to produce. And if you're sitting there saying it's all in my head, it's not a great answer. I mean, we talk about SOPs till we're blue in the face here at LeanScaper. So this is not new content or a new idea to this audience, but it's a new angle. A lot of the times we talk about it in terms of making your business more efficient, training people. It does all that for sure, but you also need to look at this in terms of like the exit environment. This is a massively important thing to a potential buyer. So,
The other
what's
thing
number
too
five?
is just on that clean books. Last thing I'll say is on that EBITDA calculation, sometimes owners will say like, "Hey, I got some cash, sales or that car, the BMW on the books, that's, it's not really business functional." Clean all that stuff out before you go to market. And the reason why, we can go to a buyer and say, hey, all these things are reducing the profit, but they're not relevant to business operation. It's just creating more questions. It's creating more friction for a buyer. It's just not clean. So it's
Yeah.
actually better to pay a bit more in taxes in the final kind of years before you go to market, because you're going to be able to present a really clean profit number, which gives a lot of confidence to not just the buyer, but also the lenders, because the buyers are often getting bank financing to do a deal. So it's really important.
Almost always. That's a really great comment. You need to be mentally prepared for your tax bill to go up in those last few years because you are, like you see, you're cleaning things up. You're removing all of this bullshit, which over 10 or 20 years you've probably said are quote unquote business expenses that definitely aren't. So all those get removed. And now all of a sudden on paper, your business is actually making quite a bit of money, which is great for the valuation. Just be ready to write a bigger tax bill in those final few years. It's a great comment. What's number five?
Yeah, so number 5 is having a consistent sales and marketing engine. So if all of your contracts and sales are coming from word of mouth, like that's great. But the problem is if you are that key sales relationship and you're the rainmaker of the organization, and I were to buy your business, are those relationships going to transfer to me? And I think all the owners will go, "Oh yeah, for sure." Like Bob loves us. Well, Bob loves you. Maybe Bob is just working with you because he feels obligated to do it. And if you were to go away, he might choose a different vendor. So having an engine where you can say, this is how much it costs us to acquire a lead on Facebook. This is our sales conversion rate. This is our contract win rate. Having all that data so you could showcase, especially to some of these private equity buyers or others that are more professional, you can go, if you put $1 into our sales and marketing machine, you can expect $3 or $4 to come out on the other side. And this is what it relates to overall profit. So you can actually scale this business. The reason why I'm not doing it is for XYZ reasons. Having that answer really dialed in is super important.
Well, the word that jumps out to me is engine. It's not just, "Hey, you need to have consistent sales and marketing." Well, that's a given. You need to have a sales and marketing engine, and that's a really useful visual, guys, because an engine has, a gas pedal, and you're able to sort of press on it to increase its power and then move the vehicle faster, and a sales and marketing engine is no different, and so I'm curious, Morgan, like in this blue collar space, what are the main components of a sales and marketing engine? I'm thinking what are you trying to show? Really productive lead channels, a strong sales force, a clean and optimized CRM. Like, is that generally what we mean by that? Can you expand on it?
Yeah, I would say in the small business space, the standard's pretty low. So if you do have a dialed in CRM, like if you just have one, that's a win. If you have the ability to say, here's our sales funnel, our marketing funnel, and this is each kind of how we've managed that, and basically some data behind it. And you can work with firms and to dial that in, but being able to show again how you're generating leads in a consistent way, and knowing that where your marketing dollars are going and what it's actually producing is going to really help with defending your valuation. And also with, hey, if you say, hey, where our business is set to grow, and someone asks you, how are you going to grow it? And you don't have an answer for that, it's going to be, they're just going to discount that in all the growth projections entirely.
Um, Number 6 on our list here, you have removal of redundant assets. Is that what we talked about, or like getting rid of the BMW, or is it something different?
Something different. So it's actually going to be, let's just say you have a bunch of lawnmowers in your business, and let's say you got like 20 different lawnmowers, but like 4 or 5 of them are just kinda, like, really old, and they sit in the back of the shed, and they don't get used. It's actually better to either sell those off or even just scrap them when you
Why?
go to
You would
sell
think
your
that's
business.
worth something. You would think it's helpful to have extra stuff in the shop or extra stuff in the shed. Is that's not the case?
It's not the case for kind of two different reasons. The main one is that more sophisticated buyers actually like businesses that can produce more cash flow with less assets. They're trying to buy something that's asset light because what they want is to say, if I want to grow this business, I don't want to have to invest a bunch of profits back into buying more equipment to grow it. So if you can show that you can produce the same results with less, it's actually a better thing. And if you say, oh, yeah, but those are old ones, we don't use them. It's still gonna create that question, uncertainty of the buyer saying, like, do they use it? Do they not use it? Why do they have them if they're not useful? And so it's actually just a cleaner picture to get them off the books entirely. The other thing too is if you have like cars or trucks or things of that nature, they're all gonna get diligenced, and they say like, yeah, 4 of these are okay. 4 of your trucks are gonna need to be replaced. Now they're doing the math of, okay, 4 of those are gonna have to be replaced down the road. That's gonna be more costs. Whereas if you just get them off the books, if they're not actually being used, it's better.
There's a term in the design world, so graphic design, web design, landing page design, that I've learned called cognitive load. And what that term means is, let's use a website. How much cognitive load is this to understand the point of this page, the products they sell, and what they're trying to communicate? And what you want to do in the design world is reduce cognitive load. If you look at a really If you just kind of look at a really well done website, one that you land on, you're like, wow, this is beautiful. I get who these people are. I kind of understand how to navigate it very quickly. What you're experiencing is not the colors or the buttons. The term that they use is the designers on that site have reduced the cognitive load. So it's just very obvious to you. And there's something similar going on here I'm picking up on when you talk about like getting rid of all this stuff. Make sure it's clean. Make sure what I think what we wanna do is reduce the cognitive load of this deal for the buyer. If it's if it's thorny and hairy and there's all these nooks and crannies involved and there's the shed in the back with all the extra equipment, but now there's a whole bunch of extra math required to actually figure out the valuation on that. It's like, I don't wanna do this. And so I think, is that a fair kinda comparison? Like, you want to really make this as simple and clean and as light a cognitive load as possible for the buyers, and I think the
Yeah,
removal of redundant asset piece ties into that, yes?
100%. You're just reducing buyer friction. Just like any other purchase decision, especially as they get bigger, you want to reduce that friction as much as possible. I think that's like, to use another analogy, in the car purchase or car dealership space, the traditional car dealership experience is not great. Like, you're spending a ton of time, you're going to all these different side rooms, you're getting like pushed for financing packages, it's complicated. And then people who have bought a Tesla have gone through, and it's like you show up, you press a couple buttons, and the car, you customize it, and then you buy it and you go. And it's just reducing again that cognitive load of making the decision. They've just packaged it so that you just don't even have to really think about it. And that's what we do as M&A advisors, is package your business so that we know exactly what buyers are going to be looking for. We make it really easy for them to get to a purchase decision and then actually make the deal happen.
Yeah, it's really cool. What's the next thing on our list?
The last one's arguably the most important, which is owner dependency. So I talked about a little bit about elevating your team and starting to get that general manager and things in place. This goes back to that analogy I used at the beginning, that if you are, that YouTube channel with that big personality that's basically driving the whole business. If you're that big personality, it's going to be really hard to find a copy of yourself out there to purchase your business. It's probably the number one reason why businesses don't sell, is that the owner is working 80, 100 hours a week doing every single different function, and there's no real delegation that's taken in place. So probably one of the best things you can do, this takes a bit more time, but if you are 2, 3 years out, is spending as much time as possible to try and elevate staff to get a general manager in between you and the day-to-day operations, which is gonna be hard for some people, especially if you love being kind of involved in the business. But that is gonna be one of the biggest things that drives a ton of buyer interest if you do have a general manager in place who's willing to stay after the sale completes.
So, buyers don't want something that is hugely dependent on the owner. Is putting a GM in place kind of like the most typical move in the playbook, or are there other ways to do that?
Yeah, like, it doesn't need to be necessarily like, it depends on the scale of your business. It maybe isn't a fully a general manager, but I'd say the one that you wanna do, if you don't have the maybe business is not at the scale to put a general manager in place, it's offloading, like, quoting and estimations
Right.
as early as you can on that sales front. Because if you, especially when you're doing install and it's complicated, like, owners sometimes forget when they've been doing this for 20, 30 years, they could like estimate by basically doing a phone call without even seeing the site and getting like asking the right questions. A new purchaser coming in cannot do that. And so you offloading that, and it'll also force you to build all these other things to say, like, oh, well, how am I going to train the staff? What's the systems or the tech to be able to do estimations between multiple people? How can I train my team to do that? Okay, I got to build an SOP. Offloading that relationship in the context of the conversation we're having today is probably one of the lowest hanging fruits to improve the saleability of your business.
There's an eighth I'm gonna add here, and you can layer in on it, which is, growth trajectory, and so this is like, we learned in grade whatever in math, the slope of a curve is rise over run, and so, yeah, your business can be growing and should be growing. The steepness of that curve matters to some degree as well, doesn't it, Morgan?
Yeah, yeah. So I would say that you definitely see a lot of this in small business where it's like we had an up year, then we went down, then we went back up. And again, buyer confidence, not super strong unless you're like starting to see that the year over year growth. So whether that's pricing increases or cost increases, there's the different levers that you got to do. Having a functioning sales engine so that you can reinvest each year to continuously see a 5 to 10% annual growth rate, even just that will really help your business. And obviously, if you're growing more, 20%, you're going to see a lot much stronger multiple. And the reason why it changes the multiple is that now the investor is looking at the current price of the EBITDA. But if you're growing 20% a year in 5 years, the business is gonna grow like 100%, right? So it's like they can kinda do that math of, "Oh, the business is gonna be able to double in a short period of time, so the multiple I'm paying today is actually pretty cheap, because next year's multiple, it would actually be a little bit less because profit's gonna go up by 20%." So that's why it makes a big difference, for sure.
Okay, last couple questions here. If you we've covered a lot of ground. If you were advising a landscaping company and they're like, "Hey, Morgan, I want to sell in 2 or 3 years," and you kind of think about everything we've gone through so far, where would you coach them to start?
Yeah, so that's typically where we what we do with our exit navigator program is we give a really specific report. If I was gonna give some generic advice to that would apply to anybody, is do an audit of your week. So this week, whatever day of the week it is, do a full week. Write down, take like notes of where you spent your time, and be accountable to your hours. Don't like put your actual hours down. If you work 60 hours, write it down. Write down all the tasks you're doing, and then identify 25% of them that over the course of the next month you can delegate. That would be the first thing I would do for any owner that's really actionable today. The next thing I would do is have your accountant run a customer concentration report. So look at your revenue over the last year or your current contracts and see how much as a percentage of revenue each customer makes in your revenue mix. So if one customer, if you do 1 million in revenue and you got a customer that does 100,000 revenue, they're 10% of your overall revenue. If there's anyone that's over 25%, figure out a way to increase the sales amongst your other customers to even it out, or find new customers to get them down below 25%. That's kind of like a gold standard you kind of want to have. So less than 25%. So that's another thing that I would focus on is, again, looking at auditing your time and delegating, and then also looking at your customer concentration revenue mix today. Those are two things that you can probably work on right away that, and it would apply to any business owner. And if you want more specifics, please reach out and we can talk about your business in particular.
We will link that exit navigator as well in the description. You can check that out and play around with it. I love little calculators and tools like that. I'm sure people will have a ton of fun with it. Morgan, this has been awesome. One thing to wrap, just what is the single biggest myth that entrepreneurs have and believe about selling their business that isn't true?
The biggest myth that I see all the time is it's usually they're gonna get a revenue multiple on the sale of their business. So they don't know, they've heard rumors, they like, "Oh, this person they sold their business for 10 times revenue or 5 times revenue," especially on the service side, because they heard that some tech company sold for that. It's just not the reality. So I'd say that there's dumb money or this foreign investor as well. I hear that all the time. Like, "Oh, an investor will come in and buy my business." Well, if you're running the whole thing, who's going to be running it? An investor can't buy it. So I would say that's the biggest thing is that there's this mystery buyer that's going to come along and pay them 5 times their revenue, and they're going to be able to ride off into the sunset. Unfortunately, that's not the reality. It does take a lot more work, and selling the business, it's takes a couple months to get your business ready to sell. I'd say the time it takes to sell your business is a lot longer than what people think. It's not a week's process, it's months, sometimes up to a year. So have that in mind when you do think about selling.
Morgan, you are a wealth of knowledge. This has been an awesome kind of walk through business valuation, private equity, the landscape industry, the blue collar economy, and I think probably the first of many. So thank you so much for doing this today, and would love to have you back in the future.
Anytime, Benji. Thanks for having me on.